Okay, well, good morning, everyone. Good morning, everyone, and welcome. Let me begin by acknowledging the Yurraga, the Turrbal, and the Gadigal people, who are the traditional owners of the lands on which we meet today, and of course to pay our respects to all elders, past, present, and emerging. First, a disclaimer, and taking into account the current COVID restrictions that are in place across much of Australia. The presentation for today is being delivered using our in-house infrastructure rather than through an external provider. And so while the production quality might not be as high as it normally is, the setup that we've got today significantly reduces the number of team members that are in the office, and I'm sure you'll understand why this is the case, and like everyone, we're all doing our best in these circumstances. So I'm joining you today from Brisbane, the home of the 2032 Olympic Games, and Jeremy Robson, who's our CFO, of course, is in our Sydney office. Jimmy Higgins, the CEO of Suncorp New Zealand, joins us from our offices in Auckland. And reflecting the current lockdowns and the restrictions, the other Australian-based members of the leadership team will be joining us via teleconference from their respective homes in both Brisbane and Sydney. So up front, let's turn to the result. And this slide presents the high-level P&L for the FY21 year. The group's cash earnings are up by 42.1%, with strong underlying performance in each of our three businesses. The improving performance in the Australian GI business has been supported by mark-to-market gains on the investment portfolio. Along with the improved profit in the bank, this more than offsets the impact of increased natural hazard costs on our New Zealand business. And pleasingly, we finished the year with a very strong capital position. I'll discuss this in more detail in just a moment. So turning to the next slide, and I've called out here some of the key financial highlights that are embedded in the result. But most importantly, the momentum that we have as we move into FY22. Our Australian insurance business has delivered headline premium growth of 5.5% for the full year, which is the best full-year revenue performance in almost a decade. Importantly, growth in the second half was particularly strong, up by 7.1% versus the PCP. In the critical consumer portfolio, when you adjust for the portfolio exits, premium growth was 7%. And driven by both rate and unit count. Commercial GWP increased by 5.3% when you take into account the construction portfolio exit during the course of the year. In CTP, we have improved customer numbers across Queensland, New South Wales and the ACT, the strongest growth in many years. Prior year reserve releases, which exclude the BI provisions, were 2.9% of net earned premium, again well above our long-term assumption. In New Zealand, premium growth remains very strong at 9.2% for the full year and over 13% in the second half. In the bank, we've returned to growth in the home lending portfolio. At call transactions and savings accounts both grew by over 16%, and the net interest margin improved by 13 basis points to be 2.07% for the full year, again well above our long-term range. All of this resulted in profit before impairments in the bank increasing by a very satisfactory 5%. And finally, group expenses increased by 1.9%, landing in line with the guidance we provided at the first half result. So now to the capital management initiatives that we've announced today. And as you know, those of you that have been following us for a long period of time would know that we have a long-held commitment to return to shareholders any capital that is surplus to the needs of the business. We entered COVID with a very strong balance sheet, giving us confidence and flexibility through the early stages of the pandemic. And I'd make the point that unlike many of our competitors, we've not had to raise discounted equity, and we've been able to maintain our dividend within our target payout ratio range. Now, while there's still risk associated with the external operating environment, the outlook for the business and the economy is more positive than and that's the lens through which we reviewed the balance sheet position as we came into this period end. Our final fully franked ordinary dividend of 40 cents per share means that we have effectively delivered a payout ratio at the top end of our target range for the full year, which is the way we like to run it. In addition, we have declared a fully franked special dividend of 8 cents per share, which takes advantage of the modest amount of franking credit surpluses that we have available to us. Today, we're also announcing an on-market share buyback of up to $250 million to be completed over the next 6 months. But importantly, following these activities, we will continue to hold a robust capital buffer of almost $400 million above our conservative board-agreed targets, and we're holding that at the group non-operating holding company level. This will enable us to continue to navigate the ongoing uncertainty with confidence. Now, before handing over to Jeremy, I'd like to make the point, and it's an important point to make, that today's results should be seen in the context of the group's 3-year plan, which we first outlined to the market in February, and we stepped through in detail during the investor series in May. That plan builds on the work we started when I was first appointed the group's CEO. 2 years ago, almost to this day, I said my priority was to align everyone at Suncorp around improving the way we deliver insurance and banking products to our customers in Australia and New Zealand. To do this, we set about simplifying our portfolio of assets and our products to enable management to focus on driving improved performance in our core businesses. Now, at the top of this slide, across the top of the slide, I've called out some of those key milestones. Following the sale of the Australian Life business and Capital Smart, we completed a strategic review of our wealth business, subsequently announcing the sale of that business to LGIA Super. Post-balance date, we've continued our progress with the sale of our 50% interest in the RACT insurance joint venture in Tasmania, again, very consistent with our strategy. Now, we believe each of these divestments has made strong strategic sense, representing good outcomes for shareholders, customers, and of course, employees. We've also exited a number of underperforming portfolios, and while this will have a short-term impact on revenues, it will ultimately be accretive to margin. Now, on this slide, I've also included our key strategic initiatives. These should be familiar following the investor series in May. To recap, insurance, our priorities are revitalising growth, optimising pricing and risk selection, being digital first in distribution, and best in class in claims. In New Zealand, we will grow our brands and strategic partnerships, digitise and automate our processes, and as in Australia, we'll deliver best in class claims outcomes for our New Zealand customers. And in bank, we are focused on winning in home lending, simplifying products and processes, optimising distribution, accelerating digital and everyday banking, and driving targeted growth in our business bank. The initiatives we have, they're clear, they're simple, and we believe the results we're presenting today confirm the good progress that we're making. I'll return to all of this later in the presentation with some proof points, but first, let me hand over to Jeremy to run through the financials in more detail.
All right, thanks, Steve, and good morning, everyone. And look, I do acknowledge as well with Steve that it is a pity that we can't be doing this update in person this morning, but as Steve said, I'm sure we'll make best of the circumstances. So I'd like to start by reinforcing Steve's comments about the quality of the result we're presenting today. We're pleased with the performance of the business and the momentum this result demonstrates as we deliver on our strategy. It supports the confidence we have in achieving our plan and reflects the robust and disciplined approach to delivering each of our strategic priorities. The business is being well managed with strong prior year reserve releases and finalisation of the pay and leave review in line with expectations. And as Steve said, our balance sheet and capital position remain very strong, which has allowed us to announce a range of capital management initiatives today. So I'll now run through the results in a little more detail, starting with the Insurance Australia business. As Steve said, GWP finished the year up 5.5% on a headline basis. As you'd be aware, headline GWP growth has been impacted by a number of factors, including portfolio exits and last year's embargo on landlord insurance. So, to help better explain our GWP growth, the numbers in the chart adjust for these impacts. And on this basis, total GWP grew by 6.7%, which is the strongest growth we've reported since 2013. The home portfolio grew by 7% as we continued to reprice the portfolio for higher natural hazards and reinsurance costs, but with a small decline in units as we focus on margin remediation. The motor was also up 7%, supported by both average written premium and unit growth, reflecting our targeted approach to marketing and improved customer offers. Pricing remains consistent with underlying claims inflation. The growth in commercial reflects a combination of ongoing premium rate momentum and solid retention rates, particularly in the fleet and NTI portfolios. This was partly offset, though, in Resilium, but we did see retention rates stabilise somewhat in the second half. Our workers' compensation was up strongly across all states, driven by higher retention and wage and new business growth. The small decline in CTP reflects market pricing dynamics as the impacts of scheme reform continue to become clearer. But very pleasingly, we achieved unit growth in Queensland and New South Wales and ACT through the motor dealer channel and an improved digital experience. Turning next then to claims, and I've included the usual undiscounted claims waterfall on the slide. In consumer, motor claims costs reflect both growth in the portfolio and underlying inflation. While Suncorp continues to benefit from its preferred repairer network, cost increases were driven by higher parts prices and a higher proportion of total loss claims. And we saw some frequency benefits in the first half, but frequency largely returned to pre-COVID levels in the second half. Home working claims were lower, with benign frequency in theft and relatively stable water claims. While some parts of home claims have experienced inflationary pressures, underlying inflation has remained around mid-single-digit levels. In commercial, the reduction in claims reflects reduced frequency and benign large loss experience. And elsewhere, claims were largely driven by the portfolio growth in workers' compensation, offset by an improvement in CTP, which reflects our focus on claims process improvements. Prior year reserve releases were above our long-run expectations at 2.9% of group NEP, excluding business interruption movements. We saw continued releases in CTP, and we had small releases from the consumer and commercial portfolios. But we did also see a modest strengthening in the long-tail personal injury portfolio. Natural hazard experience was slightly above the allowance and up on the prior period. Now, reinsurance only recovered on one event this year, which does mean we held higher risk margins compared to the previous year. Excluding natural hazards, risk margins increased by $26 million and CHI by $74 million. The majority of this risk margin increase relates to portfolio growth, and the increase in CHI reflects the costs supporting both the delivery of key projects, including best-in-class claims, and ongoing compliance with our regulatory program of work. COVID-19 impacts added $72 million to net incurred claims. The key movement was the additional business interruption provisions recognised in the first half, with similar working claims benefits across both years. Moving now then on to investment performance. And our portfolio delivered strong returns, supported by the rebound in break-even inflation and equities. I remind you that we have approximately 21%, or $2.2 billion, of our tech reserves in inflation-linked bonds, which are designed to provide some hedge against inflation in our long-tail claims portfolio. We're proud of the capability of our investment team and the work we've done on both strategic asset allocation and the selection of our investment manager partners. The underlying yield on insurance funds was 66 basis points, approximately 45 basis points above risk-free. Now, this is below our expected 60 to 80 basis points and reflects very strong manager performance, but with headwinds from lower credit spreads and ILB carry. I'd also like to update you on our recent strategic asset allocation review, where we've made some modest changes, with the overall objective being to optimise ROE, but with a view on managing P&L volatility. So in insurance funds, we've increased our allocation to high-quality credit by approximately 3%, largely from cash. And in shareholders' funds, we've increased our equities portfolio back to medium-term weights by approximately 6%. We're also continuing to assess the optimal level of inflation hedging through the inflation-linked bond portfolio, as well as shareholder fund allocations to a more diversified portfolio of growth assets. And I note that these changes may result in a modestly higher asset risk charge, but I emphasise that we retain the overall quality bias in our investment portfolio that served us so well in recent times. Turning now to New Zealand. After consistently strong results over the past few years and strong top-line growth this year, profit has been impacted by higher natural hazard costs and lower investment income. GWP grew over 9%, led by the direct AA insurance channel, with strong new business growth and good retention. We also saw good growth in Vero Commercial. Net incurred claims were up almost 18%. Natural hazard costs were the highest in the last 5 years, driven by 6 events over $5 million, following 2 years of benign experience. Working claims costs increased primarily due to unit growth, as well as motor claims normalising following the COVID lockdowns in FY20. While we're closely watching for any evidence of inflation emerging in the supply chain, inflation overall was relatively benign through the year. The operating expense ratio improved, with top-line growth outpacing a modest increase in expenses. Investment income was lower, with the increase in rates impacting on the fixed income portfolios, particularly in the second half. And the life result was broadly unchanged, reflecting an improved claims experience, offset by unfavourable interest rate movements, also particularly in the second half. Then to natural hazards for the group, and our natural hazard costs exceeded our allowance by $60 million. Whilst this is disappointing, it is in the context of a La Niña weather pattern with a significant number of smaller events. Only one event resulted in a modest reinsurance recovery this year. We announced in July that we've successfully placed our FY22 Reinsurance Program with a structure unchanged from FY21. The group's maximum event retention will remain at $250 million, with an upper limit of $6.5 billion. And limits for the drop-down and AXL treaties have also been maintained. The natural hazard allowance will increase to $980 million in FY22, as we've previously flagged, reflecting portfolio growth, inflation and a modest strengthening in assumptions, offset by the impact of the exited portfolios. Now, we believe the Reinsurance Program and natural hazard allowance strike the right balance between ROE optimisation and earnings and capital volatility protection. And pleasingly, the cost of reinsurance and the increase in natural hazard allowance for FY22 are in line with the assumptions embedded in our 3-year plan. Moving on then to group underlying ITR. As you know, we seek to neutralise the volatility from natural hazards, investment markets and reserve releases from this metric, so we can provide you with a better sense of the underlying performance of the business over time. I do note, however, that there is still some inherent volatility, in particular in the form of timing and quantum of current year valuations and some residual investment market impacts. So the starting point for the chart is the first half 21 underlying ITR of 7.1%, excluding COVID-19 benefits. And all the numbers I talk about here exclude the COVID-19 frequency benefits. The movement in underlying ITR over the half was largely in line with our expectations, with a modest improvement driven by improved working loss ratios, partly offset by a temporary investment in strategic initiatives. Now, this investment drove the majority of the increase in expenses, but also with some additional investment in marketing and technology as we drive for growth. The important margin bar on the right-hand side of the slide captures the movement in our working loss ratios and largely reflects 3 key elements. Firstly, that we've seen margin improvement across most of our portfolios. In particular, the home portfolio is benefiting from the repricing for higher natural hazards and reinsurance costs we've previously flagged, and commercial margins have improved with ongoing pricing momentum and benign claims experience. Secondly, New Zealand margins declined due to the normalisation of working loss ratios to more sustainable levels, as we'd expected, and includes some mixed impact from the higher portfolio growth in the AA motor portfolio. And lastly, to my earlier point about inherent volatility, we also saw favourability from current year CTP releases and commercial large losses. Now, importantly, looking ahead, we expect the underlying ITR in first half 22 to remain broadly in line with or better than second half 21, but with the overall margin improvement to accelerate in the second half of FY22 as the benefits of our strategic initiatives kick in. And we believe that will clearly demonstrate a very clear pathway to hit our 10 to 12% target in FY23. Now, in this outlook, as I said at the start there, we haven't included the impact of the recent lockdowns on motor frequency, given the level of uncertainty around this. Now to Banking and Wealth, which delivered a profit of $419 million, reflecting strong net interest margin and the release of some of our collective provision balance. Profit before impairments increased 4.6% to $550 million, again reflecting the improved net interest income and a stable cost-to-income ratio. Despite a reduction in lending over the year, one of the most pleasing elements of the group result has been the momentum and growth in mortgage lending in the second half. As Steve mentioned earlier, lodgements and settlements have increased significantly, while improvements in processing turnaround times have been maintained and are now better than most of the major banks. Lodgements over the second half of the year are up 71% on PCP, culminating in mortgage growth in the month of June of $182 million. But we have continued to see high levels of loan repayments, increased property sales and elevated refinancing activity. But importantly, we remain better than market in terms of retention levels. Net interest margin increased 13 basis points over the year. This was underpinned by ongoing growth in transaction accounts and lower funding costs, including the benefit of the term funding facility. The full year NIM of 207 basis points is well above our target range of 185 to 195, and we do expect it to trend back to within the range over the next few years, reflecting industry funding and pricing dynamics. Bank operating expenses increased 3.7%, largely from the temporary increase in strategic initiatives, with the cost-to-income ratio holding broadly flat at 57.1%. We continue to target a cost-to-income ratio of around 50% in FY23, with the momentum we're seeing in home lending and the emerging cost efficiencies giving us confidence we will achieve this target. On credit quality, the credit quality of the lending portfolio remains strong. Just a reminder, 80% of the book is in residential mortgages, and those have now got a dynamic LVR of 61%. Past due loans have reduced over the year, but with an increase during the second half. This movement reflects typical seasonality from Christmas spending patterns, along with the transition of some COVID deferrals into hardship. Now, on those deferrals, the majority of customers who received COVID support last year have now returned to performing. And in respect of the current lockdowns, while it is still early days, we've only seen a relatively small number of customers apply for relief. We've reviewed the key economic assumptions which underpin our collective provision, and this has led to a release of $60 million. This results in a year-end balance of $195 million. Which continues to incorporate a prudent set of assumptions reflecting the uncertainty around ongoing lockdowns, as well as the vaccine rollout. To group expenses then, which were $2.8 billion for the year, consistent with what we flagged at the recent investor series. Project costs have increased over the year, primarily due to the temporary step up in spending on strategic initiatives, and the majority of spending this half has been on digital-first experiences and revitalising growth in insurance. And in the bank, our investment has been focused on winning in home lending. We also saw a modest increase in growth-related costs, with increased marketing offset by lower commissions. And technology costs increased, mostly in relation to the new telephony platform, and increased cloud hosting costs as we get on and digitise the business. I also note that we incurred $55 million of restructuring costs, which are included within our cash profit and have been reported in the other profit after tax line. These reflect costs associated with implementing our new operating model, as well as real estate and store optimisation costs. I'm pleased to say we've delivered the benefits we expected from our operating model changes, and these have helped to offset inflation and other cost increases. Looking ahead, operating expenses in FY22 are expected to remain around $2.8 billion before returning to $2.7 billion in FY23. Finally, then, moving on to capital. And I've shown in this chart the movement in CET1 held at group over the half. Now, Steve has already talked to the key elements of capital management, so I won't cover them again, but just wrap it up by saying that in total, the group will have declared almost $1.2 billion in capital returns to shareholders in FY21. The chart shows CET1 held at group of $637 million before the share buyback, and the pro forma capital position after the buyback of $387 million. The capital usage you see on the chart was largely a result of an increase in targets from some adjustments to our models and changes to strategic asset allocations in GI and risk-weighted asset growth in the bank. We also saw additional dividends being returned to the group from the New Zealand and bank subsidiaries. We plan to hold a modest buffer of franking credits to ensure we continue to fully frank our ordinary dividends while allowing for some of the inherent volatility in the franking account balance. And our dividend policy remains unchanged, with the group aiming to pay annual dividends based on a target payout ratio of 60 to 80% of cash earnings. We also remain committed to returning any surplus capital to shareholders, which we will continually reassess, taking into account the needs of the business, the economic outlook, and any regulatory guidance. And with that, I'd now like to pass back to Steve.
Okay, well, thank you, Jeremy. And let me just briefly, before we move to Q&A, highlight some of the key proof points that demonstrate the progress against the plan, the FY23 plan, and those key 12 initiatives. In the Australian insurance business, our activity, the plan of attack that we've had to reinvigorate our brands, to refine our customer value propositions and improve our marketing, are translating to stronger growth, and you can see that in today's numbers. In pricing and risk selection, we've continued to reprice our portfolios to take account for the higher industry input costs, and we're also making good progress with the rollout of our new pricing engine. We expect the first deployment of Gwp, which is our new pricing engine, across the home portfolio by the end of the year. In distribution, we're effectively leveraging our previous investments in digital and data, and we're meeting our customers' increased appetite to interact with us digitally as a result of COVID. Digital sales and service levels grew by over 13% in the past year and now account for 33% of all sales and service transactions. That means we're well on our way to our long-term target of 70% digital, 30% voice in insurance sales and service. Our best-in-class claims program has achieved a number of critical milestones in recent months, with the deployment of Claims Centre 10 and the implementation of several new assessment tools and automation initiatives. Our building panel is currently being reviewed and is expected to be settled by November. In New Zealand, we've made good progress growing our brands and partnerships. Again, that's referenced in today's numbers. Our best-in-class claims program is progressing, and we're continuing to automate to reduce manual processes and simplify our customers' claims journey. In the bank, you can see that Clive and the team are making good progress on their 5 key priorities. Now, winning in home lending is the top priority, and here we define success against 3 targets. Our first priority was to get positive home loan growth, and we've achieved that. Our second target is to achieve market share growth ahead of our ultimate objective, which is to consistently match best in market for home loan origination. Digital engagement at the bank has also increased markedly, with over 600,000 digitally active customers and over 1 million Suncorp app logins recorded every week. So in summary, our priorities are simple and clear. The team and I are focused on executing these 12 initiatives, which, as you know, are the cornerstones of our FY23 aspirations. However, I point out that achieving the financial outcomes that are embedded in the plan relies on everyone at Suncorp understanding and living our purpose, and in turn delivering for our customers and the communities we live and work in. Now, this slide, which we first shared with the market at our investor series in May, provides a framework for how we see value being created at Suncorp. It's very different to the way a financial services organisation would have historically presented to a shareholder audience. We firmly believe that purpose is central to everything we do at Suncorp. We know it will ultimately be a key differentiator for our organisation and that will underpin our future as a sustainable, investable and growing business, just as it does for those companies that can truly be defined as leaders in their respective fields. Now, nowhere has that purpose been more apparent than in our response to multiple natural hazard events, the ones that we've managed over the last couple of years. In FY21, we dealt with 23 separate events, around 50,000 event claims, and over $1 billion in natural hazard claims costs. So on the left-hand side of the slide, I have recapped our 4-point plan for building a more resilient Australia in the face of a changing climate. We've backed our advocacy, and we supported it by our One House initiative and the Build It Back Better product feature that you saw in the video at the start of the presentation. Our purpose has also been front of mind as we're dealing with the impact of COVID. Now, since the beginning of the pandemic, we've prioritised the safety and well-being of our customers and our people and provided relief and support to over 85,000 insurance and banking customers. We know that short-term relief can go a long way, and in light of the current lockdowns, we have reinstated the banking and insurance support packages that were a feature of the initial lockdowns. Now, along with the support we provide to customers, Suncorp has a proud heritage of supporting communities. In FY21, we contributed $9 million to a range of community organisations across Australia and New Zealand, including the Queensland and Victorian State Emergency Services, the Australian Road Safety Council and the Shine organisation in New Zealand. Now, as I discussed in the last slide, supporting and advocating for customers and our communities ultimately contributes to improved outcomes for shareholders. So in conclusion, we are pleased with the results we've reported today. They reflect the hard work and the dedication of all Suncorp people. Collectively, they have rallied around our purpose and they've focused on our customers. Now, of course, while the uncertainty from COVID is far from over, we have good momentum, we have a sensible plan and a capable and aligned team, and we look forward to answering your questions. So why don't we now move to the Q&A session, and we'll open up the call to some questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Andrew Buncombe with Macquarie. Please go ahead.
Hi, thanks for taking my questions and congratulations on the result. Just 2 from me, please. The first one, you've indicated your medium-term targets for NIMs are going to step back to within the 185 to 195 range. But it would be helpful if you could give us a bit more colour on how you're thinking about them for FY22, please. Thank you.
Okay, I might get Jeremy to answer that if you don't.
Yeah, thanks, Steve. So, Andrew, I think it's fair to say that margins are elevated in FY21. A couple of factors. One of them being the lending book in the first half of 21, where we had the cash rate reduction, which didn't all flow through into the given where the funding rates were. So, I think what we will see out into 22 is the some of the ongoing dynamics of improved run rate benefits on the funding side of things. So, get a full year benefit on things like term funding facility and some of the hard work we've done on repricing the deposit portfolio. But on the other side of the equation, we'll see, we think we'll see some market pressure coming through on the mortgage side of the book. Net, we think that will mean that the margin will track down from the current elevated levels. Not necessarily flagging that we'll get to within that target range in FY22. That will be over a number of years. So we will still be elevated, but it will be below where it is today.
And Andrew, I just add to that, just to turn people's mind to the sort of progress around our liability mix that we've achieved over the past 2 or 3 years. And again, that's been driven by digital and very much biased to transaction banking accounts running off expensive term deposits. So, we've got now a very strong liability mix in the banking business, and again, we continue to have the comfort and security of that A+ rating that we go to the market with on the wholesale side as and when it's needed.
Yeah, that makes sense. And then my second question, please. Just interested in a bit of colour as to why you're changing your pricing engine for home and motor. Thanks.
Okay, I might kick off and I'll see if Lisa wants to add anything to it. I think if you go back to 2004, 2005, with the introduction of Gwp, which was a leading pricing engine infrastructure at the time, that created a very strong competitive advantage for us. It allowed us to price down to the individual home on the home portfolio and created a huge amount of data for us to be able to improve our risk selection and pricing. I guess over time, like any technology or any infrastructure, it's overtaken in the market. I think some of the more modern and contemporary pricing engines, particularly the Cape pricing engine that we looked at first in 2015, have superseded what was a very good pricing engine in Gwp. And I think it's the evolution of our business, our ability to focus end-to-end on loss ratios. And loss ratios are everything from your marketing, your branding, your pricing engine, right through to claims, and that end-to-end view that we have. And we felt an appropriate investment in new pricing infrastructure and capability was a necessary part of the program of work that we have in place. So it's not to disavow or talk down the infrastructure that we had previously. It's just the next generation and the sophistication of pricing that some of our competitors already are utilising that we can now very much take off the shelf in a very de-risked environment and implement, which is driving confidence in our ability to improve loss ratios over time. Lisa, did you want to add anything to that? If I can push the technology to see if we can bring you in.
Yeah, thanks, Steve, and thanks, Andrew. I think Steve summed it up well. The pricing engine, Cape, that we'll be putting in is a more modern engine. We've been using it for the last couple of years, as Steve said, in an offline environment. We know that today we have limitations on our ability to incorporate new data sets at speed and the volume of that, and Cape essentially takes away a lot of those constraints, allowing us to continue to invest in data and pricing risk selection.
Okay. Thanks, Andrew.
Thank you.
Thank you. Your next question comes from Kieran Chidgey with Jarden. Please go ahead.
Morning, guys. Just a couple of questions, maybe starting on GWP. I think I saw 115 mil flagged as the drag for portfolio exits through FY22. Just confirming that is sort of the full number, and whether or not there's sort of any additional remedial actions planned in terms of remaining portfolios, or you think sort of you come to the end of that sort of remediation across things like intermediated personal lines and construction?
Yeah, I'll get Kieran to add to the answer, but there's nothing foreshadowed at the moment other than to say that I think you've seen and hopefully appreciated a discipline that we have in reassessing our portfolios and taking the difficult decisions that need to sometimes be taken when portfolios aren't delivering the necessary rate of return or aren't delivering the appropriate level of customer outcomes. And they've been decisions that I think have been sort of wandering around the business for probably 5 or 6 years that we've taken, which I think were very appropriate. And of course, they do have a drag on revenues. They create a lot of noise around how we adjust and normalise to get a real like-for-like underlying improvement in our written premium, but they were necessary to take and ultimately will be accretive to margin. Jeremy, did you want to add anything to that?
No, just to confirm that you picked out that right number, Kieran. It's $115 million is what we're calling out as the impact in FY22.
Okay, and Steve, just on home, I mean, you've had good unit growth in motor. do you think with the introduction of the new pricing engine, that we will move back into a unit growth outcome for home through 22?
Yeah, Kieran, I think, we in an environment where we've had to materially readjust pricing in the home portfolio to take account of the adjustments that we've had to make to our natural hazard allowance and the increased cost of reinsurance. We have had to push, unfortunately, through some reasonably material increases through that portfolio. And there's always going to be a disconnect, as you know, between various of the insurers in terms of the timing of those reinsurance renewals. So I guess we probably front-end load a lot of those price increases and have to maintain a discipline through that process to get them in and get them earning. So I guess the way we've looked at the portfolio the last couple of years is that, we don't want to see material reductions in unit count. We don't want to see a deterioration in the franchise. So we're managing it very carefully and pushing through the appropriate amount of increases at the same time as keeping our unit count on a like-for-like basis sort of in the 0 to 1.5% reduction territory, which is where it's landed. I do have high hopes for Cape. And it's just not me saying that. I talk to people embedded in our business who've been doing pricing and risk selection for many, many years, and I can see the glimmer of excitement in their eyes around having this new technology and this new infrastructure available to us. It will significantly improve the sophistication of how we do price across the portfolio. And I'm very confident that it, along with the natural evolution of the pricing cycle insurance, will see that unit count start to normalise back to flat, and then ultimately to sort of in the 0 to 2% positive range, which I think is where we probably want to land it over the longer term.
And Steve, I'll just add to that. Sorry, can I just add to that on the home units? That I think FY22 will be a little bit of a transition year for us in the sense that we've called out that we had to do some margin remediation on home, and so we've put through reasonably significant price increases through that portfolio ahead of what we consider to be the more sustainable margin remediation over the longer term, which is the strategic initiative benefits. And so in FY22, what we expect to see is some of that blunter pricing coming off, and then some of the strategic initiatives benefits starting to come in towards the second half. And so with that transition, we'd also then expect to see some reversion to hopefully getting into positive unit growth territory.
Thanks. And just a final question. You called out the rate increases, I think 4.5% in motor, around 7% in home. Can you give us a feeling for what the average rate rise across the commercial portfolio was? And you've also previously, in recent times, said you think that portfolio is now close to targeted ITR margins. So just wondering why you're not pushing that a little bit harder on volume if you're still seeing rate and you're already at your targeted profitability levels.
Yeah, look, there's obviously a risk dimension that sits in that discussion as well, and we're always readjusting our capacity on various lines of business that we're writing and whether we want to lead or whether we want to follow. So there's always adjustment that comes through the renewal. If I were to talk to it in the way that I traditionally talk to it, and hopefully everyone's familiar with it in terms of the packaged SME business, rate increases through that portfolio of 4 to 6%. In the mid-market, the broked mid-market, there's high single-digit increases probably on non-loss affected business and higher for loss affected business. And then in the property portfolio, the top end, again, I just caveat that by saying that that's not a market that we're, that heavily represented in or represented much at all for that matter. That's sort of, 15 to 20% increases across some of those portfolios. And to confirm, our margin position is pretty much where we would like it to be, so 10 to 12% in those portfolios. So I guess to the extent that you're not seeing unit count and volume increase, there's a couple of factors for that. Obviously, in the package business, that's been the part of the business that's been most impacted by some of the COVID issues, and very conscious of that and the current situation there. We are investing in some digital infrastructure there, both in terms of our direct proposition and our broker proposition. And then it's an adjustment based on risk around some of the capacity that we deploy into some of the lines of business that we're writing. But we're very comfortable that the margin's where it needs to be and that the pricing that we're getting through is holding up pretty well.
And Steve, sorry, Kieran, I'll just add on that one that, when you look at the GWP growth in commercial of around that 5%, as Steve said, packages have been impacted by COVID, but also by some of the changes in the broker book for us around Resilium. If you look at the more traditional short and long tail portfolios, we've seen GWP growth of getting on for 10% in FY21, so 9%. And given that we, as Steve said, we're not doing too much in the large end of property, there's some pretty significant and attractive improvements in GWP portfolio growth, as we call out across motor and the NTI portfolio.
That's great. Thank you.
Thank you. Your next question comes from Andrei Stadnik with Morgan Stanley. Please go ahead.
Good morning. I wanted to ask two questions. First, if I can ask on the clean underlying insurance margins excluding the COVID benefits. Given how strong pricing has been for some time, so it should now be earned or being earned, and investment yield has already normalised at low levels. Why wouldn't you expect the underlying margin to improve in the first half of 22? Like, what are some of the potential headwinds that you're keeping in mind?
Jeremy, I might get you to run through that.
Yeah, thanks, Steve. So, look, we can certainly see the improved margin coming through those price increases in home. As I flagged, we'd look at 22 as a bit of a transition there. We can't continue to put through, those sorts of price increases through the portfolio over the long term. So they will start to come off and start to be earned through. So 75% of those price increases that we've put through to remediate natural hazards and reinsurance costs, the historic increases there, will have earned into the book in up to the end of 2021, and then 95% by the end of December. So they will start to come off, still coming through, but start to come off. We will see some improvement in things like expense ratios next year. As we've said, you can see costs will be relatively flat with the elevated strategic spend still in there. But with NEP growth, that obviously improves we get better leverage around expenses, maybe a little bit on Chi. I mean, these are around the margin, but maybe a little bit around Chi. The rest of the portfolios we'd probably expect to be relatively flattish. And I called out in the presentation some of that volatility, particularly thinking about CTP current year releases that we got in FY21. They're not big numbers, but I think net across all of that we get to a relatively level outcome in first half 22. We said in line with or better than, so it's around, but hopefully a little bit better, before they start to accelerate in second half 22 as the benefits of these strategic initiatives really start to kick in.
Thank you. And just to clarify, is it better than the 7.1 or the 7.4?
The 7.4. So whether 7.4 is the right, exactly the right exit rate, that's what we're talking to. Is we're talking to the development from 7.1 to 7.4 to in line or better than that, 7.4. And importantly, all these numbers exclude the benefit of potential benefit going forwards of COVID motor frequency.
Thank you. And for my second question, I wanted to ask around your capital management priorities. Given you retain a very healthy buffer and you've shown an appetite to return excess capital to shareholders, could we be thinking from this point onwards that you want to maintain some sort of buffer, but otherwise you would be prepared to pay 100% of earnings back to shareholders?
Look, I think it's a good question and probably an obvious one, and one that we're probably not going to answer to your satisfaction today, because as we steer into the future, I mean, there is still uncertainty, and I think we've put ourselves in a very strong position here to be able to undertake capital management initiatives, and before that to not have discounted equity to prop up our balance sheet through the initial stages of COVID. So we're very careful in striking the right balance. and not only that in the form of the instruments that we've used or are using to return capital to shareholders. And we do have still some uncertainty in the external outlook. So I guess the commitment that we have is that as we come through and the full year, I mean, the starting point would be to true up our ordinary dividend to 80% payout ratio for the full year. And beyond that, we'll do a very pragmatic assessment of the needs of the business going forward and any uncertainty that might be sitting in the market that we might want to be prepared for, any investment that we might want to make in the business. But beyond that, our commitment after those things are taken into account is to return excess surplus capital to shareholders in the most efficient form we can.
Thank you.
Thank you. Your next question comes from Ashley Dalziel with Goldman Sachs. Please go ahead.
Thanks. Morning, Steve and Jeremy. Just an initial question on the margin guidance you've given for the first half of 22. I guess if we roll back to the Insurance Investor Day, you were talking to a flat margin FY 22 on 21, and now you're kind of suggesting a flat margin sequentially into the first half and then improvement in the second half. So I guess it's a bit nuanced, but that is a bit of an upgrade on the outlook in a relatively short amount of time. So just, I guess, a question on, where is the improved confidence coming from? Is it more kind of external factors, the pricing that you're seeing, the cycle benefits, or is it more around, the internal projects where you're building momentum and confidence?
Well, yeah, look, it is all nuanced and it's all very difficult to, in a COVID world, Ash, to sort of really get everyone level set on what the dynamics are. What we do know unequivocally, if you can see it, that the business is performing strongly at the written premium level. I think that the first priority that I always felt we needed to do was make sure our brands were working well. And so we sort of, we didn't have the infrastructure in place to really fix that overnight. So what we did first up was create virtual brand teams to align the whole organisation around improving the way that we landed the brands in the market. I think we've done a great job on that. I think that's reflected in the overall premium outcome. But most importantly, I think the brand or the portfolio that is most leveraged to the Healthy Few brand and the way that you're marketing and the way that you segmenting your customers is the motor portfolio, and there's been some tremendous outcomes there in that motor portfolio. So the business is performing well, and that's giving us a huge amount of confidence. At the same time, the deeper we go into the program of work, the more committed we are to understand that these 12 things that we're focused on are the important things to drive margin improvement across both the Australian insurance business, New Zealand, and in the bank. So yes, we are getting more confident around the program of work. We still have a lot of execution to do, and we're monitoring that very closely. So there is an improving disposition within the business around the program of execution and the alignment of the organisation, which is flowing through to increasing confidence. Jeremy, do you want to add anything to that?
I'll just reinforce, Steve, that it is a bit nuanced, and we said broadly in line with 22, broadly in line with 21. So yeah, look, on balance, we're probably it doesn't mean it's going to be exactly the same, but I think broadly in line with is not a bad starting point. Maybe on balance we've got a little bit more optimistic, but what we see relatively flat 21 into 22, a little bit of early green shoots in 22, but we'll see that acceleration coming through back half of 22 and into 23.
Yeah, thanks. And just a second one, partially related, but in terms of thinking about the building blocks on the margin into 22, last year you gave us pretty granular guidance around your reinsurance expense. Obviously, we can see where the allowance is reset to, and in its own right, I mean, that doesn't present a huge headwind to margin. So just wondering, what you saw through renewal and whether you can give us any help in understanding the trajectory on the reinsurance expense.
Yeah, look, I think I'll hand to Jeremy in a minute. Jeremy's running the Reinsurance Program these days, alongside a really great team that have led into that renewal for us. I think that the reinsurance renewal took a potential concern off the table for us, and I guess for the market more generally. I think there were plenty of people making doomsday predictions as we were working our way through around a multi-year material reset and reinsurance margins. We hadn't contemplated that in our roll forward of our FY23 plan, and I think we're pretty open with the market around that. So we were delighted that the program landed where it did, and it's a function of a couple of things. Firstly, there is still plenty of capacity in the reinsurance markets more broadly, and we saw that coming through the renewal. Australia and New Zealand are still very attractive places for reinsurers to park their capital. It provides a necessary diversification benefit for them, and that's important to them because it elevates their credit ratings, which are very important for getting on programs around the world. So those two dimensions continue to roll through, and I think generally, and I don't say this is a Suncorp specific issue, but they do appreciate the underwriting capability and sophistication that's sitting in the Australian market, and I think very comfortable with Suncorp as a counterparty. So those macro outcomes were all positive, and so we were able to land the balance sheet outcomes. First up, as you would expect, and pre-book, pre-bind a number of them through the period from February through to May, and then landed the residual balance sheet covers and also the aggregate covers and the drop downs as we came into the latter part of June. So I know I'm not sort of giving you a perfect set of circumstances other than to say that the combination of the reinsurance program and the increased allowances are consistent with those that we applied in the FY23 plan, so haven't needed for us to restate anything relative to what we've already put in the market. Jeremy, did you want to add anything to that?
I'd just also add, Steve, that of course the recoveries against the reinsurance program are always an important part of that renewal process, and as we said, this FY21 we only had one relatively small modest recovery against the program, which also helped get us to where we need to get to. And I think when we gave the Investor Series update, I think in Q&A we said that the expectation was that we'd land around in line with where we're pricing the portfolios for inflation, which is sort of where we've landed. So, Steve said that it takes away one of those potential headwinds took away one of those potential headwinds to margin.
Okay. Next question. We'll move on to the next question, Ash, if there's nothing more.
Thank you. Your next questioner is Nigel Pittaway with Citi. Please go ahead.
Well, thank you. Good morning, guys. Just first of all, if I could delve a little more into what's happening on motor. I mean, you've said obviously pricing remains consistent with underlying claims inflation, but at the same time you have mentioned that frequency moved around a fair bit with obviously COVID-related impacts. So, I mean, how have you been addressing that in terms of pricing, in terms of, periods where frequency is a bit lower? And, should we be factoring in any sort of adjustment moving forward for what's going on currently?
It's a good question, Nigel. Obviously one we pay a lot of attention to because understandably when people aren't able to use their vehicles, your ability to reprice, is reduced. I mean, that's just an honest reflection of where things are in the depth of lockdowns. What we saw through the course of last year, and again, we're pretty data rich in terms of understanding mobility trends, obviously through the prism of frequency and accident rates, and severity and frequency data is very available to us. So we did see, as you move from stage 4 restrictions all the way back down to stage 1 movements in frequency. And I guess our assessment is that while, yes, when you're in lockdowns, mobility is reduced, accidents are reduced, severity moves around a little bit, but the progress out of lockdown sees a pretty rapid acceleration in mobility and a rapid acceleration in claims frequency. And in some jurisdictions, not all, but certainly some, we saw frequency rates go above the 100%, bearing in mind 100% represented pre-COVID levels. And so it did move around. So in terms of the portfolio, again, we have to step back from, what's going on in a particular week or any particular month and look at the longer term outcomes for the portfolio. Inflation in motor sort of running 4 to 5%. I think on an underlying basis, we might be doing a little bit better than that, given the fixed price arrangements that we have across a big part of our book. And we'll maintain a consistent and disciplined approach to pricing to that through the cycle or through the immediate cycle. Again, we need to step back from it and look at it over a longer period of time and understand what's happening with supply chains, what's happening with behavioural changes for consumers, etc., and the stock of vehicles on the road. But generally, in a nutshell, we'll look at a longer run view of inflation, underlying inflation, and price to that consistently through the 12-month period.
Okay, thanks for that. And then maybe if I could just follow up on, I think it was Kieran's question earlier. I mean, it is quite interesting in the commercial space because you're saying you're sort of happy with your margins as they currently stand, which I don't think is a common refrain across the industry. So does that actually give you an opportunity to sort of target sort of slightly faster growth in that commercial space moving forward, given where you are vis-a-vis your competitors?
I mean, yes, it does. I mean, it does allow us to do that. But by the same token, we have got a reputation, hard won, around disciplined underwriting. And again, we have to be very comfortable with the risk that we're taking on in those portfolios. We've got to be comfortable that we've got the capability to write that risk. And we will move around, as I mentioned before. So, we will have an appetite to be, deploy a significant amount of capacity into some lines of business, and we'll want to reduce others. So I think at the moment it's a case-by-case scenario. We're not going to do anything that undermines the overall risk profile of that portfolio, nor are we going to price at anything that's below our targeted margin range at this point in the cycle. That's not really what we want to do. So we'll be disciplined. We'll maintain margins in that range, and to the extent that we can get incremental growth, as you suggest, we will take it. But again, it has to be within our risk appetite.
And Steve, I'll just add to that, where we see a good growth opportunity in commercial is in that packages space. And as Steve said, the precursor to that growth in packages is really around the investment that we need to make, which we're getting on with, the investment in digitising the pipes into the platforms, etc., underwriting tools in that part of the business. So we see opportunity there, but we just need to get on and deliver to our investment, which is part of that strategic initiative process we've spoken about.
Okay, and then maybe just, you mentioned you had a small top-up, obviously, in bodily injury. I mean, I realise it's pretty small for you, but it probably does have wider market implications. So, are you convinced that sort of that's just a modest thing and not something that we should worry about in a go-forward position, or is there a risk that a small top-up this time sort of blows into a bigger one moving forward?
Jeremy, do you want
me to get Steve? Yeah. Nigel, our suspicion is that others have seen this as well, and it's what others have called out. This is not the first time we've strengthened bodily injury. In fact, I think this is probably the third half. And the first strengthenings were a little bit more significant. This one is relatively modest. At the end of the day, it's a relatively small portfolio for us. So, maybe there is some pluses and minuses going forward, but I'm not sitting here concerned that we've got a major potential headwind facing us in that portfolio.
And maybe just finally focusing then on Queensland CTP, you've obviously had some improvement there in claims. Can we now say the current accident year combined in Queensland CTP is below 100?
I'll get Jeremy to answer the specifics of the current year performance, but I would call out embedded in this result again. Probably two of the most relevant proof points I would identify around the improvement in the franchise over the last little while have been the motor performance I talked to previously, but also the Queensland CTP performance. As you know, over the past decade, we've taken our market share there from mid to high 50s to sort of low to mid 40s. And that's been a gradual deterioration over time. And this is the first result I can recall in Queensland where we have turned around that trend and we've grown our unit count. And that's simply because we've got a very focused and aligned team around doing the things that are always very obvious, the cross-sell opportunity that sat there between comprehensive motor and CTP, the digital opportunity that we know is there, and also our ability to attract a greater share of the new car market, which is a critical enabler for, obviously average claims cost to improve over time. Again, we've seen some movements in regulator pricing there, so that's obviously, drives some written premium, NACRAM written premium trajectory. But equally, we're deeply working, ferociously at the moment around improving our average claims cost in the Queensland scheme. And again, a huge program of work that's embedded in the best-in-class claims initiative to improve outcomes for customers in that very problematic end of our claims management, get people off claim and get them back to living and back to work as quickly as we can so that we can improve the outcome for the customer and improve the average claims cost. That program of work is really going well. And we think that over time that will be reflected in improved valuation and our ultimate goal of having our average claims cost sitting at below the scheme average. So if you can get your average claims cost in a scheme like Queensland CTP sitting below the average of the scheme with 45% share, it's a very good outcome for customers and shareholders. Jeremy, do you want to talk to some of the current year dynamics?
Yeah, look, Steve, I think we're still a little bit ahead of industry average on claims costs, but there is a good news story. There is a good news story in there in the sense that we are tracking down a little bit. But the reason why it's not tracking down as fast as a headline as we can see it underlying is with a lot of that work the team has done, we have closed out a lot of older claims. So we've taken people off claim, which is a good thing. But that just means then that slightly elevates that claims loss ratio. But it elevates it in a good way, and we can see some good underlying momentum, as Steve said, to get us back down to below industry average.
Okay, great. Thank you.
Thank you. Your next question comes from Matt Dunger with Bank of America. Please go ahead.
Yes, thank you for taking my questions. Jeremy mentioned the inflation being benign. Just wondering specifically on home whether there was any change in the mid-single-digit inflation you'd previously talked to, what benefits you're getting from the supply chain optimisation versus labour and material costs associated with COVID moving.
Jeremy?
So in home we are, inflation's around that 3 to 4% at a loss cause level. As whilst the strategic initiative benefits really start to accelerate in the second half 2022, we still see a little bit of them at the moment with the work that Paul and the team have done on some of the sourcing and some of the data modules that have been put in place. So that's helped to keep a lid on some of that average claims cost inflation. But what we have seen in home is frequency improvements across the entire set of loss cause, theft, fire, etc. We've seen improved frequency. Maybe there's an element of that that's related to COVID, but that improved frequency is therefore offset to a large extent that inflation we're seeing in the home portfolio. And look, we're seeing, we have the team has called out some of the impacts around timber pricing and labour cost, etc. But we're still seeing cost inflation in that home portfolio in line with where the industry bodies are calling out inflation in home construction.
Great. Thank you very much. And I was just wondering, a second question, if I could ask around the banking net fee income falling to $2 million from $12 million in the prior half, despite the pickup in home loan volumes. Is this due to the personal loans exit, and where will you derive future fee income from? What's the outlook for that line item, please?
Thanks, Steve. Thanks, Matt. Look, there are two key elements driving that reduction in fee income in the bank. One of them is around our everyday banking products. So we've made that fee free, and we're effectively just seeing the full run rate impact of that coming through. We think that's a virtue. The economics of removing those fees stacks up for us in terms of we can see that the other side to that sitting in margins. the improved margin from the transaction account growth. So we think that stacks up, and it gives us a very strong offer relative to the rest of the market. And then in terms of the other element to it is break fees. So an element of the fee income that we saw in the last couple of halves has been prepayment break fees, which have come off. We've also, I mean, they're a pretty modest amount, $2 million. We've also, in the second half, moved those into net interest income, which is where the other side of the equation sits. So it's been a little bit of a rebalancing there. In terms of fees, fee income, there's not a lot more fee income to run off than $2 million a half. And again, we think that's a positive that, particularly in the consumer space, we've now removed large elements of our fees so that we don't have the headwinds of those fees coming off in the future. So those are the dynamics that play around the fee income line.
Excellent. Thank you, Jeremy. Thank you, Steve.
Thanks, Matt.
Thank you. Your next question comes from Doron Kerr with Credit Suisse. Please go ahead.
Hi, thank you for taking my questions and congratulations on the strong results. Most have been answered. We're just looking at a bit more nuance on the motor inflation side on claims there. Just wondering if there's a difference in the New Zealand market dynamics to Australia, why you had motor there being benign, and also anything around the increase in total loss claims now, something specific. Presumably those claims will be higher now with the high used car prices, so maybe that would moderate going forward.
Well, inevitably there are nuances between Australia and New Zealand, particularly in motor claims. I'll get Jeremy to sort of run through some of the dynamics.
Yes, look, I wouldn't read too much into the use of the word benign in New Zealand. The reference there was, I think some others have called out inflation being reasonably significant in New Zealand motor, but we haven't seen that, was the reference to benign, particularly in New Zealand. And the motor average claims cost is between Australia and New Zealand is probably roughly a similar amount. We've seen cost inflation of in our book 3-4% against an industry inflation of 5%. And when we look at that breakdown, yes, we've seen higher average parts prices. We have seen a little bit more total loss mix. Maybe that's due to, in the first earlier parts, less cars on the road, higher speeds, more significant collisions when they happen. But we have seen more total loss claims as well. But then offsetting that for us has been our preferred repairer network. So, we do have an element of fixed pricing in our supplier network for motor that just helps moderate some of those input inflation elements to that inflation level of around that 3 to 4% that I called out.
And just to add to that, in terms of inflation more broadly, I mean, we are watching it like a hawk. I mean, again, we haven't seen much evidence of it flowing through the portfolio other than, in those particular areas that Jeremy's talked to around roofing materials and some timber. But we are watching it like a hawk. And just to remind everyone, in terms of an insurance business like ours, we watch inflation under sort of 4 categories. Obviously, there's the broader CPI basket that we track. There's the claims cost, some of which is consumed within or subsumed within that CPI basket. Average weekly earnings, which are very important in terms of the long tail book, and then superimposed inflation, which is a concept that's very relevant for the schemes that we're working in. So, inflation as it manifests itself does come through those particular portfolios. And it would be remiss of me not to make a point, having lived with inflation-linked bonds from 2011 when I was first Deputy CFO, and it's been a bit like following, your favourite football team, and they disappoint and they disappoint and they disappoint. Well, this year, I think having that portfolio of ILBs has been a material differentiator for us, and sort of underscores the reason why they have sat in the portfolio for such a long period of time. We will reassess based on where they have reset to, or break even is reset to. We will reassess the volume and weight of them that we have in the portfolio. But just to let everyone know and give everyone confidence that inflation as a concept more broadly is something that we track very, very carefully, not only with the reported data, but with the forward indicators that, you would expect us to have built into the business.
And sorry, Steve, I'd just also add that, inflation through to pricing is, again, a little nuanced. So obviously, we think about inflation in home, timber, etc. That's one element, that input cost element to inflation. There's then mix. So what's the mix of claims doing over time? And then there's frequency. And those three key inputs go through to what we need to price for inflation. So just be careful. It's not a straight line between the inflation on input costs through to how we need to price the product. There are a couple of other important elements in there as well.
Great, thank you. And just on the home input side, a lot of the overseas insurers talk to more the wage labour input cost being a bigger element than the actual raw materials. Is that the way you look at it here as well, or is it a bit more equally balanced?
Yeah, I think just generally, if you take a step back from it as an insurance company in the supply chain interaction with an insurance company, obviously, motor insurance, you are a big part of the supply chain. And so as an insurer, your ability to influence that supply chain is probably greater than it does sit in the home portfolio. And that was ultimately the reason why we built our own smash repair network and ultimately divested it to let it continue to grow. On the home side, there's obviously a lot more demand in the market. So an insurer is competing with the new construction market, the new home building market, the renovation market, the commercial market. And so we're not as big a part of that input cost. What we do have as a scale insurer, and what Paul's really focused on at the moment, is making sure we leverage our scale as efficiently as we can. And so that means, us having a view on invoices, on rates of, procurement of all the products, so that we've got a quality view across all of our suppliers. And as I mentioned in the presentation, the big focus in the next, for this half year, will be refreshing and reassessing our building panel. So we do look to our suppliers on a through the cycle basis, not to any particular demand and supply imbalance that might be there at any particular point in time. We do take a through the cycle view, but we are very much focused on leveraging the scale that we've got to make sure that we get better outcomes for our customers and shareholders.
Thank you.
Thank you. Your next question comes from Siddharth Parameswaran with JP Morgan. Please go ahead.
Good morning, gentlemen. A couple of questions, if I can. Firstly, just on the margin trajectory into FY22. Jeremy, 6 months ago you commented on seasonality that you think is there between the first half and second half. Could you just comment on whether that doesn't apply this result, and if so, why? Noting that I think you'd flagged before that reserve releases play a part, and we've seen some pretty strong reserve releases again in the second half. Just a question on seasonality and whether that should influence our thinking about the starting point on margins. And another question on margin trajectory, which is just around running yields. Where are those likely to be in the next over the next year, given you're risking up your book?
So on the seasonality question, Sid, I recall well your question at the last briefing. Look, I think the key element of, if I call it volatility, we try what we can do to take all volatility out of the underlying ITR so that it represents a true trajectory, but that's not always possible. So we do call out that current year losses, and obviously in the first half, generally speaking, we've got 3 months worth of experience versus 9 months in the second half. So to the extent there are reserve strengthens or releases for that matter, they tend to be amplified more in the second half than the first half, but not always the case. Then to seasonality, look, there are elements of potential seasonality, but they're a little bit hard to pinpoint with degrees of accuracy. So maybe there are some elements around fire, what happens to fire claims over getting ready for winter, maybe there's some seasonality in New Zealand, but look, the key one that we call out really is that in terms of that inherent volatility that's residual in the underlying ITR, maybe there is a bit of noise around seasonality, but is in that current year loss outlook and a little bit on investment markets. And with the current year losses, the two we called out really has been CTP current year releases and some of the large losses in commercial. But, in the scheme of that 140 basis points of margin expansion, they sort of largely offset the benefits there, sort of largely offset the retraction in New Zealand. So reasonably modest and offset by what we're seeing in New Zealand. In terms of the trajectory, do you just want to clarify that question for me?
So just to be clear, so you are saying there is an impact which is on the underlying, which is basically New Zealand offsetting some inherent seasonality in the starting point. So does the New Zealand trajectory continue into next year? So we should be starting from a lower number than the second half starting point, underlying margin at 7.4. Is that, and that's worth about 1.4%? Am I understanding that correctly, or am I missing that?
Sorry. Yeah, look, we have had a retraction in New Zealand, which we've called out for a few halves now, that we expect that working loss ratio in New Zealand to normalise to a more sustainable level, and we've seen that come through in the second half. So I would consider that to be a reset for New Zealand. So where we see New Zealand margins exiting the second half of 21 is sort of where we expect to see them going into 22. That current year loss reversal, it's pretty modest in the scheme of things. In our sort of outlook, I've presumed that most of that does not repeat in 22, but we've allowed for that in that outlook that I've given around the first half 22 in line or better, and then second half 22 seeing some acceleration.
Okay, thank you. And sorry, the second part of that question is just on running yields into next half. Given that you're risking up a bit, just what that should do to running yields.
Oh, sorry, on the investment portfolio. Yeah, look, I mean, the key driver to the investment portfolio is, that'll help a little bit, but it's around the margin. The key driver is where credit spreads are, and 65-70% of our portfolio is in credit spreads, and with the term of our portfolio and quality, they're sort of around, we expect them to be around 45 basis points next year. So 60-70% of that's somewhere around 30. We'd expect manager alpha of 15 to 20. And we would expect some of the ILB carry to revert to a positive, given where CPI prints are in FY22, which might add another 8 to 10. So, given where credit spreads are, I don't think we'll get to 60 to 80 basis points in 22. We'll probably be at the bottom end of that, but it's really driven by credit spreads. So yes, a little bit better than where we might have been given that rebalance to credit, but it's around the margin.
Okay, thanks for that. Just my second question is just a couple of classes which perhaps we haven't had as much detail on, just around the issue of claims inflation versus premium rates on CTP and commercial. Could you just comment on just what's happening in the market and the differences between those two? I think you've given us good colour on motor or home, but probably not the same colour on CTP and commercial.
Jeremy, do you want to go through that?
Yeah. So CTP on Queensland, we have seen some net price reductions there. So in terms of claims, I think claims are progressing as we'd expect in CTP, Queensland and New South Wales. Not too much to call out really. Claim size and frequency are running sort of where we'd expect them to be, maybe a little bit better. On New South Wales, we're not reserving the new scheme to the full 10%. I think we've called that out before. So there is discussion, obviously, that the new scheme, the first couple of years, have got reasonably profitable outlooks for them. We're not reserving to the 10% TEPLA floor anyway. So that net is upside for us in terms of where reserving goes. On pricing, we've seen some continued price reductions in ACT because of the scheme reform. We've seen some continued price pressure in New South Wales. Again, as scheme reform becomes clearer and people get more comfortable around the outlook for claims costs. But bearing in mind with New South Wales CTP, 70% odd of the outstanding reserves on the new scheme are in the common law category of claims. So there's still a degree of uncertainty outlook around that. We're seeing favourable developments in the old scheme in New South Wales. And then on commercial, we're seeing a slightly better outcome than our forced loss ratios. So we're seeing some margin improvement in commercial, which means that we are pricing ahead of inflation in those portfolios at the moment. We've seen, as I say, some good claims experience relative to forced loss. Some of that's frequency and some of it is just relatively benign large losses. But it's lumpy. Commercial with large losses, etc., can be lumpy.
Yeah, okay.
Thanks, Steve.
And just a question just related to that, the final one from me, just on superimposed inflation assumptions and AWE assumptions on the CTP book, particularly in Queensland. Could you just comment on whether those have changed over the year and whether we should still be expecting that 1.5% of the release on a go-forward basis that you assume in your underlying margin calculation?
Yeah, so we're still expecting 1.5% as our sort of, long-run outcome around reserve releases. We haven't changed substantively the superimposed or average weekly earnings assumptions in our CTP portfolio, except to say that we had a step up in average weekly earnings increasing from 2.5 to 3.5. What we have done is just modestly brought forward that acceleration. So if anything, we've taken a more conservative approach to inflation in the CTP portfolio, which, everything else being equal and assuming that inflation remains relatively benign, we'd still expect to get those level of reserve releases.
So I'd just like to be clear on that. You've increased your inflation assumption, but you're saying that profitability has slightly improved on CTP. Is that right?
Well, we have
rate reduction.
Yeah, we have slightly. So we have slightly. We've made our reserving assumptions slightly more conservative on CTP, but we've done that in the face of an expectation that inflation picks up a little bit, and so everything else being equal, therefore, we'd expect the reserve releases to be similar. And yes, there's been a little bit of price reduction, but that's not going to impact on those releases too significantly.
Okay, thank you very much.
Okay, we'll go to the next question.
Thank you. We have reached our allocated time for questions. I will now hand back to Mr. Johnson for closing remarks.
Okay, thanks everyone. And just before we go, let me just briefly mention vaccines, which are a very topical issue around the country at the moment. And just to reiterate that all members of the board and the Australian-based ELT are either fully vaccinated or awaiting their second dose. And Jimmy is in the queue over there in New Zealand. I had my second dose of AstraZeneca last month, and I'm really pleased to have done so. At Suncorp, we're advocating, all of the leadership team are advocating for all Suncorp people to get vaccinated as soon as they can, as a means of protecting themselves, their family, their friends, their colleagues, our customers, and of course the community more broadly. The chairman and I have taken that message out more broadly to the market through an open letter in today's newspapers. You may have seen that. And so in wrapping up today, stay safe, and when you're able to, please get vaccinated. And thanks, and we'll talk over the next couple of weeks.